We're super fortunate today. I feel super fortunate because I get to work with some of these terrific people on a regular basis. It's a pretty fun conference to come to because of the energy and the people and the quality and the commitment to social impact. And there's no better example of the folks who I think are really some of the leading lights in ed tech, the leading lights in social impact, than the folks that we have assembled on the panel here today. So we'll get into it. We'll do a few rounds of questions that I'll ask some of the panelists, and hopefully we'll get into some back and forth. We'll try to leave a little bit of time at the end for questions. I'll just mention, as I did at the outset, I'm John Rogers. So I help to lead education sector investing for TPG's RISE Fund. The RISE Fund's been in existence, I guess, since 2016. We reached our first closing at the beginning of 2017. Shout out to Brian Dunlap, who's one of our original founding members of the team. Rosalia Ramirez in the back is one of our rising stars on the team. But in any event, we were about, well, we're a little bit north of $5.5 billion now under management through RISE 1 and 2, and we're working on RISE 3. We're going to go around and talk a little bit about kind of how we think about the sectors in which we invest, how we think about impact, and we'll do it kind of iteratively. But we invest in everything from K-12 educational software through career professional certification and training on the post-secondary side. We're investing in special ed and mental health. We're doing that in the US and around the world. And we have each of us has a particular impact methodology. For us, we need to see a collinear relationship between impact and a financial opportunity. Often that's the case if you invest properly in the education sector. Sometimes private equity's forgotten a little bit about the impact part and has therefore gone on to lose all of their principal and do poorly financially. So hopefully impact actually is a good check on all of that. And we very much need to see evidence, third-party evidence of impact and outcomes in any investments we make. So that's a little bit about TPG's RISE Fund. I'll turn it to Iain to talk a little bit about Bain.
Yeah, thanks, John. Iain Ware, I'm a managing director at Bain Double Impact. I've been with Bain Capital about 12 years, been with the Impact Fund for about 4.5 years. Similar to John and RISE, we were founded actually in 2017, but with very much that mission of how can we bring the best of what's worked so well for places like Bain Capital and really channel those resources and support and help nurture companies that are having a really positive social or environmental impact at their core. So we do that across 3 areas: health and wellness, sustainability, and education and workforce development. And I lead all of our efforts around education and workforce development. Similar to what John said, we're active across actually from pre-K up to adult learner reskilling and upskilling, and have made investments over the last several years across all those areas. We also focus on that intersection between between training and employment on the workforce side, and have made some investments in companies that are helping to create exciting job ecosystems in smaller communities around the country as well. So excited to be here today.
Great. And I'm Vivian Wu from the Chan Zuckerberg Initiative. My background is from traditional investing at places like Accel Partners and TA Associates before I joined the predecessor to CZI in 2014. So CZI is a little bit different from some of my fellow panelists in that we're a philanthropy that was founded by Mark Zuckerberg and Priscilla Chan to build a more inclusive, healthy, and just future for everyone. We use a variety of tools in order to achieve our objectives, including grant making, policy, engineering, and impact investing, which is what I do. And Mark and Priscilla have committed 99% of their wealth towards this work. So what we do from an impact investing perspective is really look for mission-focused entrepreneurs that are building transformative companies with innovative solutions to some of the social issues that we particularly care about at CZI. And that includes some of the most intractable problems, including eradicating disease and also building incredible learning experiences for students. We typically are investing at Series B or when there's product market fit, although we have some flexibility. And we also invest along the lifelong learning spectrum and globally. So I think about 1/3 of our investments are headquartered outside of the US and Africa and India, Brazil or Latin America and in Europe.
Great. Good evening. My name's Phil Alphonse. I'm a senior partner and one of the founding partners of the Vista Group. We founded the firm back in 2013. Today we manage about $7 billion in capital, We're specialists, so we really focus on 3 verticals: education, healthcare, and financial services. We are an impact fund. For us, it means a number of things, which I think we'll probably get into a little bit later. Our model is really around bringing top, really tremendous resources, operational resources and policy resources down into the middle market. And so for us, when we greenlight an opportunity, we feel very strongly and have conviction around how we can move the needle for that particular business. From an impact standpoint, we track outcomes and a number of the external metrics that one might expect in healthcare and in education. We also, portfolio-wide, track a number of internal metrics like DEI, employee engagement, and other metrics. So our view, similar to I think what you'll hear from the panelists, is that it's not an either/or dynamic. That you can actually achieve top quartile returns and do it while tracking impact. And for us, that's a big mission for us, is to prove that you can actually do both.
So first of all, it's a real privilege to be with this panel. I mean, it's the people that really are making the world change for good. So this is wonderful. In terms of GSV, we are an investment platform with a fund that focuses on digital learning. We do not call ourselves an impact fund. That said, every investment we make from that fund, we look at the scale impact opportunity, and we won't invest in a business that doesn't have what we call a high ROE, which is return on education. We don't even, frankly, look at, how can you make money? We were looking at what kind of impact can this business have, because we think downstream there's ways to monetize and create the return. So that's a key focus for us. And I think, frankly, as this world evolves, impact investing became a thing probably 7, 8 years ago. I actually think all investing, as we evolve to the future, is going to be impact investing, because that is where the greatest talent's going to be. That's where the greatest opportunities are. I like to say we wrote a book called Mission Corporation, because I really do believe the great businesses of tomorrow are going to have the ambition of a for-profit in the heart of a not-for-profit, and what's going to drive them is how they create scale impact. We call that weapons of mass instruction, but that's how we look at this world. Thank you.
Good afternoon. Thank you, everyone. Thank you, Michael, for another great conference. This is, I believe, my 12th year at GSV, which makes me one of the GSV grandfathers, I suppose. But it's been a pleasure, and really the conference has been an incredible barometer of the growth in this sector, the excitement, enthusiasm around this space all around the world. So I'm the co-founder and managing partner for Lumos Capital Group. We are a growth investment firm focused entirely around education, human capital development, really the future of learning and work. While I've been involved in the education sector most of my career, Lumos Capital Group is fairly new. We just raised our first fund through the pandemic with a very focused strategy of deep partnership with 10 companies across K-12, higher education, workforce development, corporate learning, lifelong learning, where we're investing at the growth stages, typically $10 to $40 million equity checks in companies who we believe have the capacity to be category leaders in their particular space, who are mission aligned, who have a management team that is really out to change the world and build a long-term enduring company. We, on the impact side, have a impact framework and strategy that's focused around quality, around access, and around equity. And we have an impact advisory council that holds us accountable to that. And as John said, we also are strong believers in collinearity, certainly over the long run. In this particular sector, I feel like on that 2x2 quadrant, this is a sector where the proportion of companies in that upper right-hand quadrant should be greater than in many other sectors around the world that have great financial outcomes, but really are producing terrific student and learner outcomes as well.
All right, thanks for that. Now that we've gotten through the introductions, let's mix it up a little bit. So impact investing may be having a bit of a moment now, but there have been periods where there have been some more, I think, question or lack of confidence in the concept. And Phil, it'd be great to hear your description of the history at Vistria, because when you first raised your first fund, you didn't, I think, explicitly call yourselves a social impact fund. So maybe you can talk about what the tension is, at least in the mind of perhaps of LPs or of others, between impact and return, or what were the issues that you grappled with as you thought about whether or not to brand yourselves an impact fund?
Yeah, I mean, we launched the first fund in 2013, but obviously we were fundraising, ahead of that. And, there was a perception, and it still might be out there, that you're making a choice between impact and returns. So, I mean, we're an African-American owned fund, and we were a first-time fund, and when you walk in those meetings with LPs, you just don't want to add more variables to increase skepticism around whether or not you can perform, right? And so we had an internal charter. We talked a lot about wanting to do private equity differently. We talked a lot about what we wanted to do differently, how the composition of the GP. We wanted to have a different feel. We wanted to think about diversity as an asset. There are a number of tenets that we had that we felt really could generate alpha and create better returns. And we talked about it internally, and externally we were a lot more focused on like our angles and specific kind of attribution for value creation. And over time, I think the LP universe has just gotten a lot more interested. Our performance has, I think, spoken for itself. Our first two funds are top quartile funds. And I think as both those dynamics kind of evolved, we performed, and then the LP market started coming around. Obviously, everything that happened with COVID and George Floyd, I think, has accentuated an interest in impact and how we can do capitalism differently. And we had been talking about it all along. And so at the urging of our LPs, we just started to articulate it more and more. And it's pretty interesting now because the bar gets higher and higher every year, which I think is a good thing. So we're here now, and we actually think it's actually a good thing for the sector.
So Phil said Vistria wanted to do things differently. Michael said all education deals are impact deals. I may be paraphrasing you wrong. Victor, you said you have a specific impact framework. So Victor, to put you on the spot, is there something unique about impact, or what's different about impact investing versus traditional investing? And Michael, you can rebut me if I misquote.
I do very much agree with what Michael said, that all investing has an impact of some kind, and we really do need to ask ourselves what that impact is. We are choosing with our capital to provide resources to companies, to entrepreneurs, to management teams, products and services that are behaving a certain way in the market, are elevating a certain type of behavior, and we're amplifying that with our capital. And so it is a question that we ask ourselves all the time, and we have real responsibility, not only as fiduciaries for our LPs, but just generally as fund managers. I do think that in the sector, while I do believe that the proportion of companies in the space in the education sector that have that collinearity is higher, and that have that strong relationship between financial performance and delivering long-term outcomes to the stakeholders that they serve. I don't believe that all companies in the sector are, by virtue of being education businesses, high-impact, high-quality companies. I think there are bad actors in every part of the market, and there are businesses that probably perpetuate a status quo that we might not all agree with, or are really seeking to try and find innovation or disruption around. And I think the same is true in every education end market. So for us, we are really looking at pillars like quality and outcomes that are measurable for that particular segment, that are specific and appropriate for that type of business model. We are looking for access, and so if a company or product or service is really only affordable to a small subsegment of the market, that is unlikely to be a business opportunity that excites us. And we are looking for equity, and we think about that across every end market a little bit differently, but we do try and take a structural and systemic approach to thinking about what has created the winners and losers and the distribution of resources in a particular end market, and how does this product, service, this platform advance or not advance that particular status quo or vision of a a better future. And so we try and encapsulate this in this framework. We debate constantly within our team and also with our council on all these gray areas, because a company, for example, in the education space might create a lot more access because it is free and creates a lot of user-generated resources, but then is used within the academic context, perhaps for dishonesty or something else. And so it creates these gray areas that we do have to balance, and these are trade-offs that we have to think through very carefully in supporting different types of businesses.
Yeah, and so just if I misspoke, we absolutely don't believe that all education companies are impact companies. I think Victor said it well. The proof is in the pudding. It's really the outcomes that determine whether you create impact or not. From an investment standpoint, GSV will not invest in an education digital learning company unless we believe it has the potential to have scale impact. So that's the differentiator.
So all of your deals are impact deals, but not all education deals.
Well, exactly. No. What it's look. I mean, and the reality is, the mistakes we'll make is if we're wrong about that output, right? Those outcomes, because we will not make an investment unless we believe it can have scale impact, unless it can have an ROE. But if it does, all companies don't necessarily perform up to our expectations. Actually, all our companies we invest in perform up to right now. That's.
I do think it's an underappreciated aspect of social impact investing by LPs, that it really helps protect their downside. But Iain, you could have just done impactful deals inside of Bain. You created a separate social impact fund. Why is that?
Because I think the way I like to think about it is I think it does require that additional specialized focus. So we'll often, lots of parts of Bain Capital look at education. We have a dedicated tech fund, we have a venture fund, we have the large cap fund, and there's some delineation there purely on size grounds. But ultimately, what we're looking for in education companies is a little bit different from those. And I think what it comes back to is some of the themes that have been touched on. It's about, first and foremost, it's about outcomes, it's about access, and it's about models that can either provide differential access to underserved communities or can demonstrably enhance the achievement potential of groups across all from all backgrounds. And so, I think the slight nuance there is, versus just sort of, regular investing education generally is, you kind of lead with that student ROI or that student ROE, and so the first questions we're asking when we're looking at an opportunity are how do we think about the learner ROI? How do we assess what the right, sort of metrics are around that for this particular model? And obviously, adult learning is going to be quite different from K-12. But ultimately, it's that first question is, what is this doing differentially for the learner or for the teacher or for the classroom experience generally? And once we get, conviction around that, then we can start coming back to, okay, how do we maximize the scale of the business? Where can we invest to drive additional growth? But that baseline level of excitement around the impact and the outcomes has to be there from the beginning.
And Vivian, CZI has both a for-profit venture private equity side and then also a philanthropic side. So how do you do those two? Is there synergy between the two? Are they just separate? How do you think about those two separate arms?
Yeah, absolutely. So our vision for success is not just to build a venture portfolio of successful, discrete companies. Ultimately, we believe that the areas that we're focused on really need an integrated approach and different tools, which is why we have the grant making, the policy, the engineering, and then also the impact investing. What we see is that, for example, because we're trying to build a better future for everyone, grant making oftentimes is really particularly useful for serving the lowest income, most underserved communities and populations. But when we look at our impact investing, we see it as complementary because we really are looking for scale, sustainability, through the business model, through revenues, through profits, and really being able to scale some of these incredible solutions through technology and innovation. So that's really kind of how we think about those two. Many of the themes that folks have been talking about are things that we care quite a bit about as well. And so in some ways, being situated amongst our fellow grant makers, for example, and policy experts, really allows us to stay grounded and aligned with how CZI really sees the future for education, for example, or health. And so I think one of the things that we do is, many of the folks on our grant making team are actually educators or they are experts in learning science, cognitive science, experts in student development. And that's something that we bring into our diligence and make sure that that what we are investing in is in fact aligned to what we see as needed in the ecosystem, that it is sensitive to the needs of teachers, students, parents. And I think the other piece of it is that as we invest, our companies are often able to then tap into the ecosystem that our fellow colleagues have built, whether it's, again, through partners or researchers or scientists. And we have a team of folks who are focused on DEI, education policy, audience research, user design, all of whom our companies are able to tap into as we move along so that they can stay aligned with their vision, which is to balance their impact and their ability to actually transform the sector as well as their ability to become successful companies.
It's quite an audacious scope there to take on building the entire ecosystem for education. But if you've got those kind of goals, then you definitely want to attack it from multiple angles. Another kind of audacious thing to do is to try to invest not just in the U.S. but around the world. And Michael, you and Victor are doing quite a bit of that. What is your competitive advantage when you think about investing internationally, and how do you approach it?
Knowing Victor. No, I mean, so theoretically, in my past, I ran 2 global businesses. I say theoretically because it was really a name only. When we started GSV, we had this thesis that innovation was going to spread throughout the world, and if we wanted to invest in the most important companies, we had to have a strategy for how we were going to participate in that. And so we have been deliberate in the way that we knew that we couldn't create an infrastructure to identify, invest in, all the things that are going on. But if you just look at statistically, when we started this conference, 75% of all venture capital in ed tech was the United States. Last year, 60% was outside the United States. So you look at the 51 unicorns that have been created now, nearly half are outside the United States. So if you're going to invest in the most important companies, you got to have a strategy to do that. And how we're trying to do that is we don't need to know everybody, but we're trying to create partnerships and relationships with the key people in these geographic areas that we think are going to be the most important. I went to, before COVID, I went to China 20 times in 3 years. Over COVID, I went to the Middle East and to around the Middle East, I think every other month. And what we're really trying to do there is not see everybody, but find the right people to know that we can have aligned interest with. And, and it's we're early, but we're very encouraged by the opportunities that we've been able to find, as well as just the caliber of the people that we're able to partner with.
That's great. Victor, what's your approach?
And you can just see it, by the way, in the attendance at GSV over this last decade. It's gone significantly more international over time. As you said, all of these important companies from around the world have sprung up. For us, really it is about building ecosystems and networks globally around the world. So prior to Lumos, I was at Goldman Sachs, where I was global head of our education practice group, and had the opportunity to work with terrific education businesses all around the world. We did about $50 billion of deals during about an 8-year tenure, and half of that was outside of North America. And so during that time, people around the world, everyone cares about this subject, and everyone cares about advancing their economies through education and through better workers. So for us, it really is also about trying to find those companies where we feel like we have a specific deal angle and opportunity to partner with them in a deeper way. I'd say markets around the world are complex. They can change on a dime. We can't pretend to know more than the locals know in any given market. And so, for us, one angle that we take is if a company is seeking to expand beyond its current borders and trying to become a more regional or global business, that's where we feel like we can have some competitive advantage in helping them do that, and where we might be a better fit as a partner in doing that. And certainly, we do look for local, not only advisors, but co-investors and partners to work with us in any particular overseas deal.
And as a follow-up on all that, all investing comes with risk. Cross-border investing comes with risk. There's certainly been a lot of risk associated with China and some of the regulatory backlash. And now in the U.S., there's also some LPs that are starting to resist investments in China. Victor, what's your kind of view as to what's going on in China, and Michael, you as well, and what's the outlook?
I think that things changed very quickly in China in a very short amount of time. Some of it was somewhat unfortunate in the sense that an enormous amount of shareholder value was really eliminated really through sudden regulations. Having said that, a lot of the rationale that has been expressed by the party and by the government around the regulations, fully understandable, and understand that there are some demographic challenges that they're facing, there's some equity challenges that they're facing, and they want to stimulate additional, more broad-based common prosperity, as they've talked about. Having said that, I do think that actions like this do create black markets. They do create, just places for capital to turn. Ultimately, what we've seen is a broad pivot, right, of capital away from investing in companies in the sector towards other spaces, some in China, but really largely, if you look at what happened last year in global ed tech, 21 billion, China basically fell away completely in the second half of the year, and then this year it's been pretty much de minimis. And so the capital resource allocation really has pivoted to other places. The US and Europe have continued to grow and do very, very well. I do think that there are second order and third order effects to all of this to think through as to where capital will go in China. And for that, of course, I'll turn it to Michael.
Well, and I agree with everything Victor just said, and the benefit to move on to other questions, the only comments I'd have to what you said is I think everybody was not only surprised but shocked by the severity of the actions of the Chinese government when they took it. I mean, we all had sort of a thesis what was going to happen. What happened actually was far more dramatic than that. But in hindsight, I understand kind of why, and maybe not don't agree, but understand why. But the other thing I'll just add is my view is, I remain very, very bullish on the future opportunity for education, entrepreneurship, technology in China for 1,000 reasons. And I think now is actually a time.
Maybe more than a billion reasons.
Yeah, a billion four, yeah. But the bottom line is, it's going to be a little bit noisy for a bit, but I think opportunity is being created there in a major way. So I'm not giving up on China at all. In fact, I kind of double down.
That's great. Would love to dive deeper into themes and companies. Iain, I've been particularly impressed by some of the investments you've been making in special ed and mental health. Could you talk a little bit about your thesis there?
Yeah, absolutely. We've been very, as you said, John, very focused on special ed for the last 2.5 years, and the reason was as simple as it's a big and underappreciated market, and also, and probably most importantly, one that's been highly underserved historically. I mean, something like 15% of U.S. kids are on an individualized education plan, and there's just been chronic failure across the system to deliver them the services and the resources and the content that they need to maximize their learning challenges. Obviously, every individual student's going to be a unique case, but across the board, whether it's services or content and curriculum, we perceive that there's just been a real lack of investment in the space and an acceptance in some cases of really providing subpar services and resources. On the services side, what we have both John and I both involved in presence learning, and one of the key insights we had early on there was not only that there was a chronic shortage of clinicians for things like speech and mental health services in schools nationally, but that actually it was a particularly acute from a kind of regional and demographic standpoint. So a lot of clinicians that do exist are disproportionately in the suburbs, or working women in the suburbs, and in rural communities and in a lot of cities, there's just an enormous shortage and an enormous challenge. And so, innovative models that are using technology, teletherapy, et cetera, to be able to bridge some of that supply-demand imbalance and being able to ensure that kids who are federally required to be delivered these services, but in some cases, the school districts historically would say, we'd go try and find a clinician. If we didn't find them, too bad, and we're just not going to deliver the services, and that's just not good enough, especially in a world where there's so many technology resources that can help to at least mitigate some of those supply-demand imbalances. So that's been an example on the services side. On the sort of content and curriculum side, we've been invested in a company called TeachTown for the last 18 months, which is a leader and innovator around digital curriculum particularly for kids on the moderate to severe end of the autism spectrum. And again, that's a population which historically was just very underserved. There were some incredibly thoughtful and innovative teachers who would often come up with really compelling content and resources themselves. But in a lot of classrooms, it was just, here's the general ed curriculum, and let's try and figure out how we can adapt it to meet the needs of kids, and often, really failing on that dimension in pretty serious ways. And so we think purpose-built solutions that are addressing, particular learning challenges and learning development areas that are really tailored and focused on serving those kids and meeting them where they are and providing them that the resources they need. We think that that's both incredibly important work to be doing from the perspective of the kids and maximizing their chances of learning, but also is just a really interesting underserved market where there's a real opportunity to drive innovation and drive better outcomes and also build great companies. So.
Yeah, and Rise certainly also shares that view that it's a very underserved but very, very impactful segment. Vivian, a lot of people at this conference talk about personalized learning. I really think of you as one of the pioneers in that space. Tell us about your thesis around personalized learning, and also tell us what you see as the forecast post-COVID.
Well, that's very kind of you, John. It is an area that we definitely believe very strongly in, and we've invested significantly behind. So I'd say most of our companies have some level of personalization in their strategies, but in particular in our K-12 portfolio, we have many companies from Nerdy, Age of Learning, Newsela, Byju's, and many others that really support that thesis. And I think for us, really, this is something that permeates the work that we're doing across CZI. But in our view in education, we need to move beyond a one-size-fits-all system into one that actually builds learning experiences that are unique to individual learners. And in particular, something that we believe strongly is that it's not just about the academic needs, it's also about some of the other non-academic factors of success as well. And that's extremely important. And that's one of the places where we see technology really enabling educators to do that. So our portfolio, in terms of what we've invested in K-12, is very much built to support parents and educators to build these high-quality differentiated learning experiences that are actually personalized, that allow you to really build solutions that are customized to individual needs and desires and interests, but also their progression and their learning journey. So whether that's a company like Newsela that is building, differentiated levels of reading for their instructional content, which really kind of opens up group discussion and also individual reading comprehension. Whether that's Age of Learning, which has been for a long time the leading early childhood learning app in the US, but has really invested heavily in building adaptive learning and mastery-based apps for reading and math that's based on their commitment to learning science and curriculum design. Or whether that's Nerdy, which is probably in some ways the Varsity Tutors platform really has used technology and AI to build kind of the penultimate in individualized experiences with their one-on-one tutoring marketplace. And then, we've been invested in Byju's, which is probably the largest platform at this point in personalized. But since we've invested in 2016, the company really started from being a personalized, interactive, engaging learning app for 4th through 12th grade, and it's expanded in all sorts of ways to build one-on-one instruction, to really build online and offline product integrations, and also hybrid experiences. And so really just expanding its ability to serve the needs of students in a variety of different formats. So we're pretty excited about this continuing, and I think the reality is it's, especially for this group that has a lot of work in international markets, it's one thing already for teachers to be personalizing or differentiating for a classroom of 30 students. It's really quite another to differentiate in a classroom of 30 to 60 students in places like Brazil or Africa or India. So we're very excited about the potential.
And what's the forecast post-COVID?
What are you referring
All
to?
going to regress to the mean? Are we all going to go back offline, or what's going to happen now post-COVID?
Oh, absolutely not. So we're big believers that, COVID has accelerated the move to online learning very dramatically, just the adoption and comfort levels with technology and devices. I think that really could have taken years to develop, and COVID really accelerated it. I think transparency and visibility for parents into their children's learning, and also, as you guys were just talking about, just the what's happening with recognition of the need for behavioral health and support for and connections for both educators and students. And all of these things really do take this personalized approach of taking this comprehensive student development approach and really being able to support the needs of all these students in a variety of different ways. I think one thing I will say is that post-COVID, what we will see is a reversion to hybrid experiences, which are ultimately a great combination of in-person and online, and/or high-quality online learning experiences that are supported by mentors or very high support services like some of the investments that my panelists and I have made in companies like Open Classroom or Descomplica and others.
I love the fact that you named names, and Iain, you also talked about presence learning. Vivian, you talked about Nerdy and others. Phil, in 1 minute, give us a great example of a social impact investment you've made, and why is it a social impact investment?
In 1 minute?
Time test.
I mean, we've talked a lot about special ed, and so I'll raise it because two of my partners on a deal we just exited are here. So Jeff Cohen, the CEO, you can raise your hand, Jeff. I'm going to put you on the spot, and then Steve, you're part of the team as well. So we see some of the same trends in special education that I think some of the panelists have mentioned. I think that's a very good case study on driving impact and also financial performance. They did an excellent job growing the business, almost doubling EBITDA over the whole period that we had them. Special ed population are particularly a tough population to track on outcomes because every child has their own IEP. And so one of the things that we talked a lot about in the front end of our whole period was how do we raise the stakes and not just sell our solution as a compliance service to schools, but really up the ante and really provide visibility on student progression. And I think the team did a really outstanding job of building a proprietary tracking solution, which is very hard to do in the special ed market. They did a longitudinal study with Hopkins, and I think just creating visibility on student progression in that market is a very big deal. So they not only had great financial performance, but they did really, really outstanding work. And in selected areas too, there's a thing called disproportionality, where African American students, particularly males, get overdiagnosed as special ed cases. And Jeff and the team specifically wanted to address that issue, just being probably the largest provider of special ed services in the country, that we wanted to be really ahead of the curve around how we address that issue as we saw cases, and partnered with one of the leading professors from Temple University to do a joint effort in addressing that issue and actually provide a service to the schools that we were serving. So to me, I think that's an outstanding, it's not just because they're here and I didn't plan them, I haven't seen them all conference, but I think that's a really good example of impact at work.
Yeah, I appreciate you bringing up that factor. Iain, how does Bain Social Impact think about diversity and inclusion in your investments in your companies?
Yeah, well, we think about it an awful lot, both within our team as well as within the companies themselves. We were proud. Maybe the first thing I'll say, I think most important is kind of tracking it the right way. And so we've been, as a firm, one of the things we did, on the over the last several years is we call it Count Me In. But it's let's make sure we really understand all the different forms of diversity that we have within our team, and make sure we can first understand the data so that we can then use that to try and figure out how we can build more diverse teams and create more inclusive learning environments. Within our own team, we were very proud that now 70% of our team identify with some historically underrepresented group, whether that's across gender lines, racial, sexual orientation, and other. So that's been a big focus for us internally. And then within our companies, it's very similar. We similarly have them track diversity in their management teams and at the board level. We set targets for them to try and aspire to achieve in terms of bringing more diversity to the teams, and then probably equally importantly, as important is how do you then create those inclusive learning environments? So we're doing a lot of thinking at the firm level around inclusive leadership, both within our team and across the portfolio, and also trying to figure out ways that we can identify historically unseen or underseen talent, bring them into our organizations, and then work on training, development, apprenticeship models to try and make sure that talent has the real opportunity to thrive and succeed. And so it's been a big focus area. I think it ultimately starts with data and measurement, and then it builds into how do you build great organizations that allows historically underrepresented talent to thrive.
Are we running out of time, or how are we doing? We are running out of time. I don't know whether they're going to give us the hook. What?
3, 2, 1.
Okay, well, please join me in thanking our terrific group of panelists today.